I'm Keith McCullough, and welcome to day 2 of our Investing Summit. Thanks to all of you who were with us yesterday. The replays are up, et cetera, et cetera. We really appreciate the feedback. I certainly appreciated the real conversations. That's the whole point of this, is that I get to learn alongside you. Today, I get, very happy to have who I think is one of the world's best economists, and that's according to me, Daniel Lacalle. So you're going to have to take my survey and poll on that. But the reason why, the number one reason why, in addition to your good looks, is that I think, is that you actually did the job, right? There aren't that many economists that have your type of profile, in that you were, an analyst and a hedge fund manager at Citadel, at the mothership. So when you say something, it's from a practitioner's perspective. When you write a book, it's from a practitioner's perspective. And I think that's what makes you one of the world's best.
Thank you so much. That's very kind of you. Thank you very much. It's a great pleasure to be here. It's always a pleasure.
Well, some of his books are in the background there behind you. I highly encourage you to get up to speed on all that he thinks. But what I'm going to do here today is just get right into it and ask you I think a pertinent question that the bond market certainly is asking right now, which is, did the Federal Reserve make a policy mistake with a 50 basis point cut?
Definitely it did.
Definitely.
But
okay.
we need to understand why they did it, no? The Federal Reserve started panicking in June when they decided to slow down the pace of normalization of the balance sheet because bond yields were soaring and the level of government debt was absolutely out of control. Deficit spending was out of control, and global demand for treasuries was declining. So that was the first sign of panicking. The second sign of panicking came in September when they decided, against every indication of what they're supposed to be looking at, to cut rates by 50 basis points in an economy that, according to Chairman Powell, had no evidence at all of signs of recession or risks of even a downturn. Employment robust, according to Powell, and inflation still above the Fed's target. In fact, the only real disinflation factor in the previous months came fundamentally from an external factor, energy, no? So cutting rates was basically a way of bailing out the government, nothing else. It had no reason, because if you look at the financial conditions index, it was at the most lax, at the most open level seen since 2021. So there was no problem in availability of credit, no problem allegedly in the GDP figures, no problem in the unemployment figures, no signs of recession, and no signs of a downturn. 50 basis points cut. Who do you believe?
3%, year-over-year GDP growth. That's not even close to approaching a recession, and that, of course, was a short-term, cyclical peak in GDP, and GDP is slowing. In the third quarter, it slowed, what we would call quad 4, but again, not slowing into a recession. I think the point that you make, and the other big advantage that Lacalle has over everyone else, in addition to actually doing the job on the buy side at a major hedge fund, is that he's not like a myopic USA-only economist. In fact, he's a global economist. And when you look at the world's decisions on what you said there, I'm not sure that everyone knows, because this clearly wouldn't be the first chart that a Federal Reserve fan or a Janet Yellen fan would show, or anybody who's been the head of the Treasury for that matter. Slide 131, guys. And this really shows, the great and growing aversion to U.S. Treasury debt. I don't know if you can see that chart. Can you, Daniel?
Yeah, I can. Yeah. Yes.
So like after generally rising, as you know, for like 40 years, like basically our entire career for you and I, all the way up until 2008, foreign holdings of U.S. Treasury debt as a percentage of total have been, trending, lower now. And this is from 33% to 22%. So can you, in addition to just the obvious, which is the U.S. debt clock, I think everybody should probably know what that is. But in addition to that and the deficit and this addiction, bipartisan addiction at that, on government spending and keeping both of those numbers very, very high. How do you see the rest of the world's leaders and economists looking at that?
Well, this chart is extremely important because what you hear all the time in the United States, you hear it all the time, and you're all also fighting the good fight. Oh, there's no problem with the U.S. deficit because the U.S. debt will always be absorbed by international investors and will always be supported, and it's the lowest risk asset. Therefore, the U.S. can issue all the debt that it wants. Well, that's not true. That is not true. Number one, it has an economic limit. The amount of GDP generated by every unit of public debt has declined by more than half in 10 years. So for every dollar of new public debt, you get less than 50 cents of GDP. Number two is the fiscal limit. You raise taxes, you don't get enough receipts. Certainly, furthermore, the interest expense in the budget soars even with low rates to now the second largest item in the budget. And the third is international demand. The US dollar is the world reserve currency. The US dollar is treasuries, obviously. So when you and I were in the hedge fund world, you remember when foreign demand of treasuries relative to net issuances were higher than 100%. So
Yeah.
every time that there was any sign of not crisis, but some sort of uncertainty in markets, bond investors globally, central banks globally would pile on US treasuries. I remember in 2008 and 2007, when it was 150% foreign demand for treasuries relative to net issuances. Well, in the last figure, it is less than 30%. Less than 30%. So it's not just that the US government is issuing more and more and more debt, it's that the world demands less and less treasuries as a reserve, as something that is going to be a safe haven, as something that is going to give them a cushion, that is going to be a safe asset to own. Central banks all over the world, from China, India, Oman, so many others, are reducing their holdings of treasuries relative to their asset base and increasing their positions in gold. What does that mean? It means that there's a diminishing confidence in the solvency of the US government, and that can be exceedingly dangerous in the future if the government, the next administration, ignores the warning signs.
Well, anytime I have an opportunity to have a conversation with you and just listen to your answers to my question, you just trigger in my mind the obvious slides that in this case every American at a bare minimum should understand. Clearly, to your point, every foreign government understands this if they're reducing their exposure versus the prior. But in that prior slide, on that slide 131, there's a defined peak in 2008. Now, the question would be, okay, well, what changed in America? What changed? And if you go to slide 126, guys, we call this, if you ain't first, you're last, the Talladega Nights headline on that one. But this is showing you, and you can see it's clearly demarked here, Daniel. If you go between 1962 and 2008, again, 2008 is the point where you're saying over 100% was the demand. You had bipartisan, again, this traverses the 1960s all the way till 2007. You had bipartisan support to have some kind of control over this number, right? 23% to 50% was basically the high to the low, okay? Then, from 2008, we said, let's go to Wally World and take it to 100, or at least close to it, which is what we're just about to hit, which is the yellow bar. And beyond that, how does that, if I get one question on this topic, Liz Ann Saunders said this to me yesterday. She said, Keith, everyone institutionally and everyone who's a serious investor cares about this, right?
Yeah.
But nobody knows, what people always want. What's the trigger point? When does it? What's happening? When does the going to 172%? And we're talking about and that assumption, debt to GDP, assumes no recessions ever, no wars, no nothing. Yeah. Right? How do you think that's actually? Because you do actually you come from. I say sometimes, I think you say, I'm from the future. Actually, that's your one line. You're from the future. You've seen this happen in other economies.
Absolutely.
First and foremost, welcome. to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
A lot of people say, oh my gosh, this is going to trigger a debt crisis, and they think of a debt crisis in a sort of Greek way, no? Greek drama type of way. It's not going to happen like that. What it leads is to stagnation and persistent inflation, basically. The risk of
stagnation and persistent inflation, did you say?
Yeah, stagnation. Yeah. So what is basically happening in that chart is that government debt, instead of being something that is helping the productive economy continue to generate higher productivity and improvement, government debt is actually absorbing the ability of the economy to grow faster. So more units of debt are actually crowding out the real ability of the private sector to generate higher growth and better opportunities. And the other important part is that debt to GDP is a very bad ratio, because GDP can be bloated with more government spending and more debt. So the denominator gets pushed up, and so that's why the interest expense figure that I mentioned before is so important. So what happens is that it's basically leading the United States to secular stagnation. That's basically what it is going to do. Yes, the United States can get to 150, 170% debt to GDP. Absolutely it can. But if you want to follow France, you're going to become France. And that is why I always say, be very careful by ignoring the signals of high public debt, because what happens then is the following. Increasing taxes is not a tool to reduce public debt. It's a tool to justify higher public debt. Governments go to rating agencies and say, don't worry, we're raising taxes. They issue more debt. They don't collect enough revenues. Don't worry, we will increase taxes. They issue more debt. And the problem is that all of that is literally an enormous burden on the private sector, on the productive economy. And the US is a growing economy. It's still very productive, no comparison to the euro area or to Japan. But when you follow the policies of Japan or of the euro area, you get the level of stagnation of the euro area. And in the case of the United States, you won't get the level of unemployment of Japan, which is very low, because for that, you also need the culture of Japan, and that is much more challenging.
Yeah. Now, can you, first of all, you just front ran the next slide, actually. Are you sneaking up, are you looking at my slide deck right now? Slide 127, the next slide, actually puts, you mentioned Greece. This guy's encyclopedic, right? And that's required to be one of the world's best economists. You need to know everything before you actually try to answer a question, like what actually happened. He mentioned the country Greece. He said it's not going to be like that. And then at the end, he mentioned Japan, which is way out on the tail. But this is like the empirical evidence, of course, that rising levels of debt do correlate with slower economic growth and or stagflation, as you pointed out. Now, that stagflation is not what Japan ended up with. Right? They ended up, like, there's a difference between stagnation and stagflation. What do you think about that, where USA is today? If we just run out the plan on the debt, I mean, you're going to go out there past Greece towards Japan.
Yeah, in the process from Greece, past Greece towards Japan, you get to secular stagnation with very elevated levels of debt. But one always has to remember why Japan did not enter into stagflation.
Okay.
There are three elements, no, that are important. Number one is the demographic element. Japan is an aging and diminishing population, both things, aging and diminishing. No? That is deflationary to start with. Number two, Japan is a country in which industries are huge savers in world reserve currencies, in dollars, in euros, and pounds, because they export a lot, and people are big savers. Okay, so that is also something that reduces the risk of inflation because they're bringing in loads of foreign reserves. No, and the third is that in Japan, what you have is a massive culture of supporting the fabric of the industries with a very challenging and very difficult to replicate environment in which people save, and they actually save in bonds, in public bonds that generate no real return. So they're actually getting poorer. That's not going to happen in the United States, and it's not going to happen in. So things that are different then in the United States relative to Japan. Number one, the demographic element. Demographic element, nothing to do with aging and diminishing. It's actually the opposite. It's immigration, significant increase in immigration, and also a much, let's say, robust pyramid. So that's on one element that doesn't help you reduce the inflation risk. The number two is that the United States is a country that exports relatively little and imports quite a bit, and therefore the US dollar, if it loses purchasing power, the inflation impact exists, even if it's an oil-producing country, etc. So, for example, in 2020, 2021, the US, being the world reserve currency, should have had deflation, but it had inflation. Why? That is another, as I said, three warning signs: economic, fiscal, inflationary. So that doesn't help either, and it doesn't help either on the labor market and the industrial fabric. So, if you take out those things, the United States, with its economic imbalances and its fiscal imbalances, is going to be virtually impossible to get into a sort of called debt deflation Japanese style. It will get into the debt, but with inflation, because it is issuing a currency that's whose global demand is diminishing.
Yeah, that so that he just gave you like the answer that nobody gives you in mainstream media in a very short window of time, and that was tight, man. That was very good. Now let's tie it to, because of course, Daniel, the inflation, according to Powell, came because of supply shortages. Right? It didn't come from the money supply. It didn't come from printing money. I mean, the things that this guy and the Federal Reserve as an institution, they're unelected, obviously. They're appointed by Wall Street. They're appointed. These are appointed politicians. He's a lawyer. Like, he has talking points. He has feeling. He talks about how the economy, like you said, he cut rates by 50 basis points and had the audacity to tell people like you and I it was because the economy is just humming along. I mean, it's like, it's ridiculous. But to not, I mean, it's one thing to be Ben Bernanke, which we can go through. He devalued the dollar to a 40-year low twice, 2008, 2011. But then you have Powell. Like, guys, show, go to slide, we go to hang on here. Go to slide, the M2 slide, please. If we go to this is not exactly a good slide for him to see. Now, if you go to slide 117, and this is global M2, which was big time driven by the U.S. kind of idea here, which is print. So the rates of change on money supply, in particular U.S. money supply, and where we're at today, like how do you talk about that? Slide 107, by the way, showing you M2 from it's at over $21 trillion. I mean. And you talked about purchasing power, right? Yeah. Like what purchasing power of a dollar when you debase it by 78%, that's going to be inflationary.
Of course it is inflationary, and of course they know it. But we have grown accustomed. You and I remember when central banks were actually monetary institutions that paid attention to monetary aggregates. Now we have monetary institutions that talk about anything except monetary aggregates. Anything. I mean, it's crazy when you read the FOMC meetings minutes, but if you read the ECB ones, in which they talk about climate change, in which they talk about, I don't know, the ABBA reunion, it doesn't even matter. It's ridiculous. It is ridiculous because think about it from the perspective of the average citizen that is watching the financial media and listens to this way of thinking. Inflation is due to supply chain disruptions, the Ukraine war, and the Gaza conflict. Therefore, we're going to increase rates. They're like, what? I don't understand. What is the connection? If you're saying that it's not a monetary phenomenon, why are you taking monetary measures to reduce inflation? No, it's a very dangerous way of using communication. And you mentioned Bernanke, who used to say monetary policy is all about communication, or 80% communication, 20% action. Very dangerous to tell to people that, hey, we made a mistake, guys. We made a mistake. We increased money supply by 5 times the figure of what was previously called a huge monetary stimulus in the middle of a lockdown, and sent all of that money to governments to spend on stuff in order to bloat GDP. And when the economy reopened, all of that money, newly created money, went to goods and services and is now showing you all of that inflation, and therefore we need to reduce the quantity of money, and we need to increase rates. So the problem is that the narrative doesn't work because you mentioned it very well. It's political. No? So because they have to, on the one hand, try to maintain some level of independence, and on the other hand, continue to bail out the government debt, what ended up happening was that higher for longer lasted less than 18 months, which is the biggest joke I've heard in my life. Okay, he went on TV and all the media and said, we have to be used to higher for longer. 12 months later, lower for longer. What? You know? So this is showing why the credibility, at the end of the day, the central bank's job is not just to be the provider of liquidity of last resort. It's also to provide confidence in the currency that the government issues. So when you do these things and you flip-flop and you start saying things like inflation is due to supply chain disruptions disappear and inflation continues to creep, obviously you're making a dishonest message that is doing a very negative favor to the credibility of the institution and the credibility, therefore, of the currency.
Yeah, the institutional credibility of the Federal Reserve was shot dead a long time ago. It's almost like every bull market you bring back a new cheerleading section for what everybody knows isn't true. I mean, I don't know how this is going to end. That's beyond my purview. But other than poorly, I mean, I don't know how you could go on and on and on. The entire stock market, and let's just talk about that. The market structure that we have today is 100% a function of Federal Reserve easy money policy. Now, let's discuss that, right? Through the lens of 0 days to expiration options trading, the most levered bet, short-term bet you can make. You know, just look at every single thing that's going on once we get into these quad 2 environments, when anything that's including meme stocks isn't locked down goes vertical. Just to actually even see what it's doing to global markets. I mean, I wouldn't say that the biggest 6-day move in a major stock market's history, in the Chinese one, wasn't born out of nowhere either. I mean, if you just looked at, if you could see, if we were at Citadel, we would see, the amount of FXI, weekly call option buying that was going ballistic when that happened.
Yeah,
Because
absolutely.
so again, if you tell everyone everything's going to be a levered bet, and you don't have downside, they're going to take shorter term levered bets, and that's inflationary.
Absolutely, that is precisely it. Is that when you have created the perverse incentive that tells everyone that don't worry about absolutely anything, because the central bank has gone from being the provider of liquidity of last resort to being the provider of liquidity of first resort.
Yes.
That is exceedingly dangerous in any shape or form. And the only way in which it ends is with the destruction of the purchasing power of the currency. Obviously, a lot of people actually come out and say, well, the US dollar is not doing so badly relative to other currencies that are as bad or worse in terms of monetary policy than the Federal Reserve. Because a lot of people forget, you and I know, and we've discussed it numerous times, monetary policy is not about who wins, it's about who loses first.
Yes.
Is making all central banks make the same mistakes, thinking that there is no problem because they can continue to support government fiscal imbalances forever, and taking more and more risk and using more and more units of currency to support that risk. And then when it bursts, the one that is sort of least negative in the case, the US dollar, sort of remains relatively better than other fiat currencies. But the citizens of the United States have, in the process, as you have shown perfectly, seen their purchasing power of their wages and their deposits demolished.
Yeah, if we just show a history of the dollar, I mean, when people say things, it doesn't really mean anything to me unless I have the time series in either the back of my thick hockey head or on a chart. That's why I like to go to the charts, because it reminds us of history. But if you go to slide 136, you can see my dream chart, which is the dollar rules everything around me, because I get paid in dollars.
Yeah.
And a lot of things trade in dollars. In fact, 96% of trade invoices in the Americas are in dollars. And actually, a little known fact, but 79% of the rest of the world's is too. So if you think about that chart, Daniel, like you can identifiably see the periods of strong dollar policy, right?
Yeah.
That was Volcker and Reagan. It was actually even Clinton and Greenspan. But beyond that, okay, yeah, when the rest of the world went into reported recessions, including China that didn't report their recession, yeah, the dollar strengthened against their currencies. But now that's not the case. The UK is coming out of a recession. Japan's not in a recession. You have a lot of different things that are happening economically that are directly impacting or actually strengthening their currency against the dollar. So discuss, because we're at a big time lower high from a long-term perspective, right? If you take, if you just look at M2, and you look at the devaluation of 78% of the US dollar across the entirety of going back to 1913, you got that. But you can also just see a chart. Something that is in secular decline makes a lower high every time it goes up during its cycle.
Absolutely. And that chart is showing you precisely that process of loss of confidence globally in the central bank's assets of the entire world, of deciding, well, I used to want to own as many US dollars as I could in order to have a cushion of profitability and a cushion of stability for the local currency of whatever country we're talking about. And then it doesn't work anymore. And when it doesn't work, then all of the machinery that is built upon the idea that the world's lowest risk asset is the US dollar starts to crumble. This is the problem. You see, we have discussed this numerous times, and you say it all the time. We have two generations of traders that have seen nothing but expansionary policies. And therefore, what they take for granted what a very short period of time in monetary history, which is what we have lived in the past two decades, less than 2 decades, as something that has A, always happened, B, will always happen. This morning, I was in an interview and they said, well, the world will always accept US dollars as the lowest risk asset. And I said, always is a very dangerous word because the British thought the same about the British pound. The Romans thought the same about the sesterce, and the French about the assignats. You have to be exceedingly careful about the idea that you can always push the imbalances of the government, and you can always push the limits of patience of global investors that may and are looking for other alternatives, no? And simply because of this narrative that has been created in a very, very short period of time, I come back to this point, it's insane, as you mentioned so many times. It's insane to hear people say that money supply growth doesn't create inflation because it didn't do it in 2008. Well, number one, it did. Number two, there was massive asset inflation. And number three, money velocity collapsed. Is that people seem to forget that you are basically transferring the inflation that goes to goods and services in an economy that is not doing well to asset inflation and multiple expansion. And multiple expansion is the only bet today in global markets, almost to a T. Look, you mentioned China. I think that what you just said is incredibly important. The Chinese send a stimulus packages that is mostly supply side, rate cuts and improvement in credibility. Market immediately soars because of that unwinding of the short trade with the yuan. How long has it lasted? I think it's lost 50% already of the bounce. No, you have to be extremely worried about how quickly the perception of a global reserve currency can start to crumble. And again, coming back to all that we have been mentioning, the warning signs are already there.
Yeah, it's fascinating, like to hear someone like you put that all together so succinctly, and you go on essentially what we're seeing in terms of market structure, and I mean global macro market structure, fully loaded with the U.S. equity options bubble embedded therein. You have these very abrupt and obvious moves, like the VIX, yeah. We're old enough to remember on August the 5th, went to 65 in a day. Like, I mean, yeah. These are not warning signs, right, on the very short-term stuff. But then you have somebody like Lacalle who can come in and say, hey, you remember what happened to the British Empire, the Roman Empire? And nobody really wants to talk about both at the same time. Well, unfortunately, yeah. You and I wouldn't exist if we didn't think about everything across the entirety of time, right? And to a large extent, it's an educational thing. I think most people are educated on the matter. Guys, just go to slide 102. This is currency debasement 101, and of course, Lacalle called it out. The Roman Empire is a very good place to start when it comes to debasing your currency. Back then, yeah. They did it with the denarius, taking its silver down from 90 to 50%. But when I go back to that slide on slide 108, Daniel, this actually, the Federal Reserve, and this is saying something. Go to slide 105. The Federal Reserve took less time to devalue its currency by about the same amount as the Romans. I mean, think about that. On the right side, people can get themselves a history lesson. I mean, yeah. In just 107 years since 1913, this happened. I mean, yeah. How this happened on all American voters' watch, I know because they don't really know and their politicians aren't paid to know. It's just like, yeah. It's like it's the worst, right? It's like you're married to somebody and you're not. It's like there's nothing going on, but this is what you need to see, but this is actually what's happening. I mean, and this is America. I think this is crazy. You got a Spaniard and a Canadian that has to talk about it plainly.
And it's important that we talk about it plainly because it's very easy when you are comfortably looking at the present and think that the infamous words that we read all the time in financial media saying, nothing has happened yet. Nothing has happened yet. What the hell does that mean? What do you mean nothing has happened yet? First, inflation. Second, reduction in global demand for US dollars. Third, weakening of the bank for buck return on investment of the US dollar. What do you mean nothing has happened? But more importantly, the idea of accelerating and doing worse because nothing has happened is the same as if I go 200 miles an hour down the highway and say, hey, I haven't killed myself, accelerate. It's ridiculous. It is ridiculous. And it's and the problem is the following. Everyone that is watching us says, well, why do people that are intelligent, that know about the economy, or maybe they don't, but they talk about it, why are they saying that? Because it is the perfect tool of nationalization of the economy. What many people don't understand is that this is not due to incompetence. This is due to design. The government presents itself as the solution to the problems it creates. It sends a tremendous amount of trillions of dollars of future commitments in a currency that they issue, and they pay them back to you in a currency that is worth less every time. Therefore, you get angry because the purchasing power of your salary and your deposit savings make it more difficult to make ends meet, make it more difficult to get your kids to college or to pay for healthcare. And then the government says, don't worry, I'm going to send you yet another commitment for the future in a currency that I will issue. It's incredible. What people don't seem to understand, because people, obviously they need to listen to you, but people don't understand that money, the way that we know it, fiat currencies, and debt are the same thing. Yep. So people, what they need to understand is that the position that they are going to be in the future is going to be dictated precisely by the confidence in that currency. And it's very, very dangerous to believe that nothing has happened when it gets even more challenging in the future to make ends meet and to reach and to pay for the average goods and services, because then that creates a very significant social problem.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
Yeah, that's a very important point. It's by design. That's why. Like I wrote the other day in an early look, my daily strategy note that I write. It's whatever's happening. I'll be writing about that, the particular things in cycle time and market time that are happening. And it's like I point, because I was in Chicago for the week prior, where in your old stomping grounds there, doing meetings. And multiple meetings, institutional client meetings. One firm runs $250 billion, okay? Like big firms, right? They'll start the meeting, Daniel, like, shouldn't say start, after I start the meeting and say, this is what I think is gonna happen, inflation's gonna reaccelerate, here's our inflation nowcast, here's how the base effects work. I will routinely have sophisticated institutional investors say right back to me, how does the Fed not see this? Right?
The Fed does see it.
It sees it, but by design they want that to happen, but they don't want to take accountability for it. And that's of course the design, right? I mean, this is a little inside baseball, but like I care at this point. I mean, I don't have a boss. I mean, I can say whatever I want, and especially if it's the truth, right? When we bought a company called Potomac Research in Washington D.C. Their chief, Fed head analyst was the former vice chair of the Fed, Don Cohn. Okay, and suffice to say, so he had to work for me. Can you imagine like this? This was not a long-standing relationship, right? and it wasn't because he wasn't a nice guy, gentleman of a guy. It wasn't because he wasn't intelligent. It certainly wasn't because he didn't have a good resume. If you're looking for a Fed head to tell you what's going on at the Fed, that's the whole game inside the game. But it was actually the difference between how I analyze the economy and what he told me the Fed never would.
You know what's the problem is that when you analyze the economy, Keith, you are looking at data all the time.
Yes.
And and what you are not doing is trying to sort of pigeonhole a theory to ignore the data. The data is telling you that something may not be right or that something may be right. The problem of academia and the problem that is filling central banks and the people that are filling central banks is what you read, for example, from Paul Krugman on inflation. They say, we got inflation wrong. But all the models were saying that there was no risk of inflation. So the problem wasn't the models. The problem was that something else happened. What? What are you talking about? The models were a disaster.
It's complete bullshit. That's complete bullshit. Our model was calling for 8% inflation. We have a monthly inflation nowcast that updates every week. Yeah. And when inflation went from 2 to 4 and they called it transitory, we sent notes out to all of Wall Street that we have trillions in assets under management that passed. We're 15 years old. It's not like young Keith anymore, who's just like trying to bark up a tree, people thought. I mean, this is like the real deal. And our inflation nowcast said it was going to go from 4 to 8, and it went to 9. So, just to say nobody knew because by design we're not supposed to know. I think that's a better.
That is the thing, is that basically it's the dishonesty. It's basically saying, well, we have built these allegedly exceedingly complex models that say that everything that government does and everything that government says is good. That's an easy model to make, by the way. And we put a lot of numbers out there and it makes it look very, very complicated. But if you are making an analysis of the risk of inflation or deflation and you ignore completely monetary aggregates, basically it's like making a model on, on the next elections based on whether today is going to rain or not. It makes no sense whatsoever. So the problem is that the mainstream narrative is built around you cannot even discuss or question what comes from central banks because they know better. That makes absolutely no sense. It's like saying you cannot criticize the government. Of course you can. Of course you can. And of course you can because the track record is atrocious. I mean, the track record of the Fed in predicting inflation, predicting GDP, and predicting unemployment is horrible. So why would you even think of listening to them when they say that inflation is transitory? Furthermore, even so, what the hell does transitory mean when inflation is accumulative? What the hell is that?
Exactly.
What kind of imbecile has to buy the fact of transitory inflation when inflation goes to 4 to 8 and from 8 to 2? That's a 12% increase in inflation. Obviously, now if I gain 10 pounds a year for the next and to the other, I'm not getting any thinner. So the idea. The idea of transitory inflation is so ludicrous. This is the problem. The problem is that central banks have one mandate, which is price stability. That is fake because it's not price stability. 2% per annum increase in inflation is not stability. No? I go to the same example. If I gain 2 pounds every year, this is not going to end up well. No? So the problem, therefore, is that price stability, unemployment. Think about this, Keith. You and I've discussed this a lot of times. People here in Europe or in Japan, they say, well, we should do like the Fed because the Fed has a target of full employment in its mandate. And I say, what What does a monetary institution have to have an unemployment target? How on earth do you put together monetary aggregates and liquidity with employment? Oh, more debt is going to create more jobs. Ridiculous, no? So, and you can get now to the extreme where the European Central Bank is including climate change in its analysis of the economy. There you go. There you go. Yeah, it's basically. But the point that I go back to all the time is they want to impose central bank digital currencies, while at the same time, all that they are doing is making people less confident in the monetary institutions.
Yeah, I mean, that's why you got Bitcoin back over 60,000. That's why gold has gone roof to all-time highs. I mean, when we're talking about the Roman denarius, and the nefarious nature of the Roman Empire, the British Empire, the U.S. Empire at this point, and it'd only be clear like when it's clear to everybody. But the fact of the matter is that you look at all of it and you're like, yeah, gold's been around for a long time. But why is it hitting all-time highs right now? I mean, it's maybe we'll finish with that because we've run out of time. But why is gold hitting all-time highs?
Gold is hitting all-time highs because central banks are changing from having the U.S. dollar as the largest part of their asset base to provide stability for their currency to rebalancing it and increasing the percentage of gold. That is a huge part of the demand for gold. The other, obviously, is the reduction in the confidence of the solvency of the U.S. Treasury. But there's also an important factor that I think people should think about. When we're all the time discussing about issued debt, and we're all the time discussing about money growth so far, but what people should pay attention, particularly when they're looking at gold and at other risky assets, is unfunded committed liabilities. What matters, to be fairly honest, U.S. debt is a disaster, U.S. deficit is a disaster. And that is an important part of the discussion. But the most important part of the discussion is how much monetary destruction are we going to see in the future? And how do you measure that? By looking at the unfunded but committed liabilities, i.e., all of the Medicare, all of the expenditures and pensions and in other elements that are already committed, but they have not been issued yet. That means more destruction of the purchasing power of the currency in the future. The Treasury, in its own estimates, has an increase in debt between 2024 to 2034 of 16 trillion. 16 trillion, okay? And that is, as you mentioned before, without expecting any recession, any reduction in employment, and with record receipts every year, okay? So that's already telling you a big part of the problem. Now, you say, why does the US dollar remain as the world reserve currency while diminishing its purchasing power and all of that? In the other part of the pond, you want to know the uncommitted, the committed unfunded liabilities of France? 400% of GDP. So that is obviously what may maintain the US dollar relative to the euro, but not the US dollar relative to itself, which is what matters and which is what you are showing perfectly in those two phenomenal graphs.
Well, thank you. You're calling my graphs phenomenal. I'm calling you the world's best economist.
I love the one in which you see the dollar bill dissolve through time.
Oh boy, and we're going to keep pounding the rock here. We're going to keep working hard at educating. Clearly, if you don't believe in inflation, it's not in your accounts. I mean, I always say that. Oh, you're not long gold. I guess you don't understand it. So that's the point. Those of us. And it's a sad point in some ways. I said it this morning on the call, which is our morning meeting that people can now listen into, so they can hear all my dumb and semi-intelligent thoughts. But the point is that you're sitting there and you're watching it happen, and people are telling you it's not happening, but it's happening in your account. And it is perverse because that's how you fight inflation. You own it because the people, and this is the sad part, have to eat it, right?
Yeah.
They don't buy bars of gold. They don't buy, I'm buying junk bags of silver. You know, they don't do that. They get told what to do. They get lied to. And gold just says, I'm going to go on my own. See ya.
Yeah, absolutely. And it's going to, what we need to pay attention as investors is this is going to bring higher volatility. This is going to bring tremendous disparity between different indices all around the world, depending on the level of monetary destruction in one and the other. And it's going to bring, the only way in which you're going to be able to protect yourself against the constant debasement of the currency is by protecting your assets and your savings, investing wisely, without ignoring the risks of the spikes in volatility and the risks attached to it.
Well put, and thank you again for the education. This is one of the main reasons why we put this out there for free, because over my dead body, am I going to allow these truths not to be known by renowned economists like yourself? So thanks very much.
Thank you very much. I thoroughly enjoyed it. Thank you very much.
And do yourselves a favor. Go out and buy some gold. I mean, it's for sale today. That's the way you fight inflation. You own it, all right? Up next, we're going to have Michael Canavay, and I'll look forward to that real conversation as well.